Okay, if we just kick this off, this is a very informal presentation about what's happening around the west of the world. I just started becoming a politician, the rest of the world, and what in particular is happening to growth and what's been happening in the past 7 years. It's been an interesting time in terms of the whole planet as we go from a unipolar world to a multipolar world, what that means and how we're going to cope and what the changes are. Craig runs our office in the UK. He's also responsible for Africa does anyone here watch Wallander? You know the show? That's his ringtones. Every time I think of it, Kurt Wallander's about to appear and some grumpy Danish detective is going to start saying, "How do you feel about your mother?" So he's going to talk us through what's been happening and kind of what that means to the Australian market as that sort of changes. That's the kind of context I want everyone to think of this in. In the last 30 years, the US has dominated all our thinking in terms of where the economies of the world is going. It still does. It's still 40% of the entire world's money. But that's changing. We are becoming a multipolar world. And what that means, I'm just going to find myself a chair because we're one short.
This one?
Oh, thanks, mate. And we'll go from there. So, Craig, I'll hand this over to you.
Cheers. Thanks, Andrew. Thanks, everybody. Yeah, so today, what I'm not going to do is what I did in Melbourne, which was basically talk for too long. Conscious that you guys have allotted us some time in your lunch hour, so I won't just talk blindly for an hour like I did there. So the presentation I'm going to give is essentially the same as the one we gave last week in Melbourne, but I'm not going to reference every piece of information on there. So what you'll get after the session, one of the team will send the report over to you. Well, it's not a report, it's just a presentation. But there are some associated pieces of research that we've done which will be referenced in here. So if anybody wants access to them, then just drop us a line. There's a few different reports out of the UK, the US, which we're happy to just give away gratis for you guys to have a look at if you're interested. So yeah, just to sort of follow on from where Andrew touched there, obviously financial crisis has reshaped a lot of things in terms of thinking, traditional approaches to portfolio construction and all those sorts of things. So what I'll do, I've got sort of three parts because out of the London office, given just the time zones, we do have quite a lot to do with the events that the business operations in the US. And I personally have some responsibility for some people that we have in Cape Town and also in Sao Paulo. So this is really just a mash of lots of different things. So if you feel that it's lacking a little bit of coherence, the theme that I was told by Andrew to sort of talk about today is the idea of growth. And where is the growth happening in these markets? Who are the winners? Who are the losers? And what's happening there? I mean, at a core, what I'd sort of talk about maybe from a UK and European point of view is, and I guess this is happening here in the retail side with the FOFA initiative and those sorts of things, is asset management is changing quite fundamentally, and there's quite a few different drivers into that. Some of it is regulatory, a global push towards transparency, not the way that the industry used to operate a couple of years ago, or for 30 years beyond that, where it's been very much a sort of a selling-based industry, and products are created by the industry for what they think consumers want, and there is now a transition happening, and part of this will be driven with more velocity due to the notion of transparency, where products will need to compete on merit. A lot of the bias that was inherent in a few of the markets is being removed by regulators, and that's happening here, I believe, as well. So distribution, which was quite a simple formula for asset managers and product providers 10, 20, 30 years ago, is now being turned on its head. So that's still playing out. I mean, in the UK, they've just gone live at the beginning of the year with the Retail Distribution Review, which was basically a concept to remove, as you'd all probably know in the room, bias from the advice process and payments and potential influences of advice or products that aren't best suited to the client. So that's as Donald Rumsfeld said with his unknown unknowns, I think it was. We're also seeing a little bit of that happen in the UK around RDR. and there's a bit of a feeling out there that we might get RDR version 2, RDR version 3, so that might just be something to keep in mind with FOFA in Australia is the deadline that you guys are facing might not be the definitive date, and even just some of the conversations I was hearing around outside there's obviously a lot of challenges for those involved requiring to meet deadlines and those sorts of things. So these are all the things that are happening. Relatively weak growth in Europe and the UK, as you would all know. Government's limited, monetary policy has limitations. Interest rates are down. They can't really go any further there. The Bank of England has been, turning on the printers for some time now with about 375 bill of quantitative easing to try to stimulate growth there. They've done a little bit. I mean, there's a little bit of a conversation out there now where they're going to try to penalise banks who hold money overnight. I mean, they're really struggling to get growth basically, and that's reflected in what you're seeing in parts of Europe as well. The industry there, I mean, if you think that financial services here might not be the best liked industry, then you want to try and spend a bit of time in the UK, where it's just a comedy of errors. You just watch these guys fall downstairs with the mis-selling of various forms of insurance, various products, the initial denial, then the acceptance, and then the remorse. I mean, it's embarrassing to watch, really. So yeah, there's a massive. The press in the UK have really they've dined out on this for quite a few years now. The idea of banker bonuses, the deregulation that Margaret Thatcher put in place, the Big Bang or whatever it was called, has made the UK, and if I'm over-referencing in the UK, that's just because that's our main market. The over-reliance on financial services, which grew to an unhealthy proportion of the UK economy, and with that sector now under pressure, both due to markets but also Brussels regulatory pressure and so on, the UK doesn't really have a growth story to move there. So anyway, the two areas that I've highlighted that I wanted to talk about was really just because of the audience today, is that what RDR has done, and it's actually been in the lead up to RDR, we started to see, we've been tracking this for a number of years, is the number of advisors in the UK start to reduce. So some of that is sheer demographics, older guys looking to get out before the new regime came in. And what we're expecting this year over next year is a bit more of a reduction in those numbers, as the reality of trying to get a customer who isn't traditionally used to paying for advice, or even if they were paying for advice, they weren't even aware of it because of some of the complexities and the smoke and mirrors that the industry is allowed to get away with. Banks, because the risk to their brand, they don't see financial advice as a core area of operations, so a lot of banks have actually pulled themselves completely out of the advice process, which has created a bit of a vacuum. You can call them advice orphans or what have you, but there's an awful lot of people now who don't either have the ability to pay for the services that they need around this in quite a complex market, or they actually do not want to pay for it.
Craig, are they re-entering? Because I've heard a few of them had left.
Yeah.
And
they're re-entering in the old sense of the word, which is it's limited advice. It's more to do with products. So I will sell you a product, but I'm not going to talk to you about what that product can do. Or
but at least it's a bit more human. Because I'd heard that they centralised it all, set up a fancy website, and thought, well, this should be fine. They've obviously gone through the exercise of realising that doesn't work as well as they'd like.
Well, Santander is an example. They had 900 advisors, and they actually went past January with an advice business. And a month or so into the new year, they said, actually, this isn't going to work. We realise that none of our advisors are actually up to the level that they need to be. So they just basically pulled the plug, and the next day, 900 people lost their jobs. So yeah, look, it's yes and no. Barclays have pulled out. A bunch of others have gone. I mean, they'll probably come back in a different way, but not in what we would see as an advised operation. What we are seeing, and I don't know if this is going to be of interest to the market here, is we're projecting we're going to see the 20,000 advisors who are going to be left, maybe 19, 18, 17 as the years move on and people realise that they can't generate any business out of this market, is the dilution of the influence. So traditionally asset managers have exclusively relied on advisors in the retail space to distribute their products. what we're starting to see in the UK is under the new regime where advisors are now more than ever having to justify the charges, the costs of delivering that advice, or what the client's going to be paying. We're seeing them focus more on the relationship side, so the client relationship. And what that means is advisors who previously were acting like quasi-asset managers because they were quite interested in picking managers or picking funds and all those sorts of things, they now can't really do that. They have to focus on the client. So we're seeing, I don't know if they've got them in Australia, but there's a group out there, the wealth managers called stroke discretionary fund managers. So these are people who aren't, they're not your full asset managers. They're kind of an in-between, and they have model portfolios and they have different funds and those sorts of things. And advisors are starting to outsource to those guys. So they're actually starting to make more of the decision of what products are chosen. At the same time, paraplanners who traditionally weren't really used in the UK just because of the cottage industry nature. It's not like in Australia where you've got definitive networks in the true sense. You've got very loose networks in the UK, which is more of a thing for branding and those sorts of things. We're starting to see from our research that there's going to be a big jump in usage of paraplanners as the advisors stop doing the risk profiling and all that side of things. And then the discretionaries, which, it'll be slow to start with partial outsourcing to these discretionary fund managers. So essentially over time what we're predicting is there's going to be a reduction in terms of the number of decision makers in the UK. Some of the figures that, I've put out there as a shock jock type thing is ultimately you could find in the UK there's only really 100 people who are deciding which products and funds are chosen over time, as advisors don't actually pick the funds, they pick the strategy or they pick...
What does that mean to the index though, Greg? I haven't really thought about this before, but does the index become the benchmark of everything? So if the advisors are not adding value and if direct comes up and if the advisors are outsourcing this, how do people are constantly sourcing and trying to find a way to get utility? So does how the index is performing become this really critical moment? Does it mean that no one can actually do anything, that everyone's wedded to hitting the index all the time?
You mean index like the FTSE?
Yeah, like the FTSE.
Well, that's a separate issue altogether. That's to do with the investments that the asset managers are making. There's hundreds of funds. They're still turning out these funds, and there are still some asset managers who are sort of, walking down dead-end streets because they have to come up with a story from their business, so they're launching new funds and they're winding down old funds. But in terms of performance, there's a few slides I'll talk about in a little while in terms of the equity risk premium, and we're starting to see. Sorry.
So what you're saying then is that these asset managers, quasi-asset managers, are actually going to build portfolios specifically for clients.
Yes.
Is that what you're doing? Yeah. Okay.
Yeah.
There's a bigger culture of outsourcing to manage compliance in the UK, so that's where the trends come from.
Yeah, I think so, because a lot of people have been getting their sort of wrists slapped, and that under RDR that's going to be a lot more prominent. So it's compliance is obviously one component, but we've been looking at it more from the time, the enhanced time that they need to spend with clients now to justify their charges. But you're right, compliance, no advisor wants to get dragged over the stones on sort of thing. Rebates and platforms, so there's another thing there. There's also been auto-enrollment which has come in, so Australia's version of superannuation, but it's not full compulsion. There's basically 3 strikes and you're out. So it came in October 2012. It's a tiered process where the largest companies go first, and then in a few years' time you'll have anyone with less than 5 workers involved, and that's now an obligation for an employer to offer a pension fund to employees. In terms of how much gets paid into that, there's a bit of juggling around where the employer can pay some, the employee can pay some, but the most interesting point on that is the fact that it's not that the UK is so weak, but that the government could not mandate compulsory pensions. And obviously there are a lot of people still in workplace pensions already. This is really for the people who don't currently have a pension. So they put you in, you're an employee who doesn't have a pension, a valid pension fund. So they put you in, you can opt out. A year later, they put you back in, you can opt out again, and another time after that, you can opt out. So 3 times, and if you opt out after 3 times, then you're out. So you don't have superannuation, that's it. So what they're trying to rely on is apathy, that people just, they get put in, they stay in, and those sorts of things.
Are these accumulation funds, or pension funds, or are they defined benefit?
It's Nest. Well, Nest is the default fund, which is the government's fund that they've put in. But it's DC. I mean, DB is not really, there's no real DB in the UK. DB is legacy. So rebates and platforms, just finally on this slide, is quite funny. RDRs come in, and it's the idea that, you know, there's full transparency around advisor charging, platform charging, and these sorts of things, but there was still there was legacy behaviors which weren't necessarily wrong. It was that the big platforms were able to generate, able to get rebates off the underlying asset managers, and they came back to the client via the advisor in the form of a cash payment, which the regulator took umbrage to, thinking that that was potential for influence. So initially they decided that these rebates needed to be unitized, which caused an absolute nightmare in the industry, because some of these amounts of money are so small. So the administrative burden of providing rebates in unitized form was a massive issue for the industry. And then just to sort of add weight to that, the HMRC, so the UK's ATO, then stepped in and actually said, well, these should be taxed, so we need to actually tax these rebates, which are essentially just payments that the client's made, so it's not any form of income. So that's it's a little bit of a dog's breakfast at the moment, really. But essentially what that is really spelling is that the regulator, combined with the tax authorities there, are adamant that rebates and those sorts of payments will be basically not outlawed, but it just makes no economic sense for them to be there anymore because of those things. So I'll just touch on the US and then the other areas, and then I'm probably going to fly through the rest of the slides because I'm already talking too much, I'm just realizing. Because what I want to do today is really to try to open it up for a bit of a two-way thing, which probably would work better. So over in the US, obviously they've got their own issues, a bigger industry than the UK and Europe, but some of the things that I did want to touch on here is the US is a market where people are more used to paying for advice, but there is still a huge proportion of the population who just don't even fall under the umbrella of that. But the biggest change that we're seeing in the US is this idea that, I mean, the US are the first movers in terms of adopters around technology and new ideas. They're always trying, because it's so competitive over there, they always have to have better ideas, newer ideas to move forward. And what we've seen there is really that technology, this idea of, you know, algorithm-based fund buying and those sorts of things is really sort of pushing the pricing. So underpinning all of this, and this is something I'll talk about in the other slides, is this idea that active management is quite difficult now to just have, you know, a human being stock pick. This is at a global level. Obviously, there are individual managers such as yours that we were talking about, you know, good stock pickers and so on. But what we're really seeing there is that technology is kind of catching up to people, and there's so much information and so much decision making that needs to be done now, that we're finding some of the, not necessarily the full passives, which we were also talking about the lady back in the room before. There are other strategies involved, and if you actually trade off the returns that you're getting for that active management versus what you can get from passives, then we're seeing the passive movement in the US underpinned by huge global managers such as BlackRock and so on, and Vanguard, really driving it there. At the same time, we've got, from the distribution side of it, there's been a lot of talk in the US that wirehouses, who are, I guess, your equivalent to Tide advisors here, would sort of, you know, take a step back and move more into becoming independent and working for some of those groups over there. But none of that has really eventuated so far. We are seeing some move, and a lot of that is due to remuneration. We're starting to see a little bit of a leveling out there. Some of the big global the groups like Merrill Lynch and those sorts of guys that have, you know, hundreds, well, not hundreds, they have tens of thousands of these distributors. Some of the remuneration hasn't been there for them, so there's a bit of an opportunity. But at the moment, we've only seen 60 billion walk out the door from the wirehouses advisors, and that's on a backdrop of 5 trillion. So it's only small money there. But basically, from a retail investor point of view, because we do quite a few different projects for clients over there. And while we had that last quarter of 2012, where it's a horrible phrase I don't really like to use, but, you know, we went to that risk-on sort of mentality, Underneath that, there's still a lot of scarring that's been done for your average investor in the US. The damage that was done largely due to the property bubble over there, but the impact it then had on the investment side of things. So still an element of cautiousness there, and trust and those sorts of things. So and also the idea that investors are always the last ones to the party that were first to leave, so they always miss the bouncers as well. I'll only touch on these two countries purely because we have some consideration there. But interestingly, in South Africa at the moment, they're looking to the UK in terms of a model for what's likely to happen there. They don't have an RDR or a FOFA at the moment, but the wind is, the writing's on the wall for them there. So a lot of the manufacturers, the clients that we work with, they do have some concern that something similar is going to come in there and sort of, remove that profit fat that used to be there. And not that it's going to transfer somewhere else, it's just going to disappear. So it's just it's a shift in the industry and how the industry is going to have to operate there. Advisors, for the most in South Africa, based on the research we've done there, are generally ambivalent, so they're not really adjusting their businesses until there's something real that they can kick and see. They're not really adjusting. They're just continuing as they are. Over in Brazil, what we're seeing there, it's quite an interesting market. I mean, you hear opportunities, huge numbers of millionaires being created on a weekly, monthly basis, and all that kind of stuff. But from a distribution of financial services point of view, there's a lot of US managers over there at the moment, rep offices out of Sao Paulo mainly, trying to find a way in. But the large banks there kind of dominate distribution. It's a very fat market in terms of yields, but the problem for the international groups at the moment is they can't get in, or they're having to focus at the private bank or the family office level, because the average retail investor, there's a lot of blockers in place where they can't put, you have to be over a certain asset level to be able to invest overseas. So most of that money is staying within. So there's some crappy products that, that some of the international managers are sort of putting together to try to appeal to as a local domicile fund to the guys there. But look, the writing's on the wall there. We are going, which are CCAPs, these things down here. We are going to be seeing that market open, but it's anyone's guess when that's going to happen. But at the moment, basically, the short story is that the banks are dominating there. So. I'll fly through these charts, as Andrew touched on before. I mean, this is 2011, so the US is still the dominant asset management market, UK 8.4%, so those two combined are half of the global assets really, and we're still seeing, even though there's a lot of economies, Singapore, Hong Kong, all these sorts of areas sucking money in through some of the growing, India and China and so on, it hasn't manifested. I mean, a lot of the money is still managed in those two core areas. So this conversation was meant to be about growth, I guess, from what Andrew was asking me to do. So what I also want to talk on here is just to give you a context about where there's yield and investor expectations about what's a decent return and all these sorts of things. So as you all know, I mean, the banks who are at the floor of what they can do in those major areas, the UK, Europe, Japan, and so on. I mean, Japan's had a deflationary bust for 20 years, beyond more than 20 years, and I personally feel that the UK is in that now, and it's only after the event, in 20 years I'll look back. I mean, they're trying to inflate their debt away, but that's not really going to work because there's no growth there to be had. The US obviously has a slightly different demographic, but they obviously have huge debts which are going to be pretty difficult to remove there. So that's the conservative asset stuff. This is now the equity stuff. So I mean, historically, the equity risk premium was around up to the sort of 10% mark, and this is what, since the financial crisis, the industry is trying to grapple with, is how do they justify, or how do they appeal to investors when, I mean, volatility's come back a fair bit now, but just trying to consistently outperform. It's very difficult for active managers to continuously outperform. I mean, yeah, there are some star performers, but in terms of the whole industry, 80% of managers, they might have a good year, then they have a bad year. So there's a massive issue for the industry in terms of, well, what are they offering? What's the proposition to an investor who is very conscious of cost at the same time? I'm not saying that the market's going to run away with passives. Passives aren't necessarily the solution in all of this, but if the consensus view going forward is that asset management is only really going to return 4 to 5% for that equity risk premium, given that these cash rates are down to 0, so you're looking at 5%. And most people nowadays, if you said, we'll give you 5%, then they'll chomp at that. But let's go back to some of those countries. We're in Brazil. Okay, their interest rates have been coming down, but their interest rates are still, maybe 9%? So you can just put your money in cash. Okay, inflation might be 11%, so you're going backwards still, but why would you risk putting it into a market where you might only get 4% in equities? So this is, this is US, mind you, but globally we think there is a big challenge, and there's a lot of technology out there which is trying to fill that gap between the full passive and the full active. And whether it's enhanced or whether it's smart beta or whatever you want to call it, the fat in the market is actually, I don't feel it's going to be there going forward. I'm not sure what the situation is in Australia, what's the average balance fund been doing, but from an equity point of view, I think there's serious challenges there. That's just showing you I guess what everybody knows here is that these traditional economies, they're not the future. Their growth is flat. It's, whether, we sit here and we sort of harp on about China and India and Brazil and all these countries, but, this is the reality that the home bias that a lot of these investment managers have in these countries is skewed towards their own markets for various reasons. So that's something else to think about from an economic point of view. So, because equity markets can only really reflect the growth in the economy, and sometimes it gets ahead of itself and there's a correction, or sometimes it underpins it and the economic growth goes ahead, which is rare, and then they catch up and there's a bit of a boom in equities. So this is the various countries. They can call it whatever they want. In the US they've got a name for it, but basically it's just printing money and trying to liquidate the markets. The impact it's had on the UK pension funds, for example, the relation between the government bond yields with annuity rates, it's I think it's knocked down the average DB pension in real terms by about 40% in 4 or 5 years, just because the yields have just fallen through the floor there. So massive issues with printing money. And our equity is cheap. Okay, this is up to 2011, but a whole load of money ran into equities. But if that's not underpinned by growth, and maybe there are some asset managers in the audience who can sort of give me a flavour for what the PE levels are in Oz, it doesn't necessarily mean that the equities are particularly cheap. That's a PE on average of 20 something there. Okay, I'll try and speed this up a little bit. So we do a big annual study of retirement. This is 150 countries. So the guys out of London, I think they use about 40 different metrics using IMF data, OECD, all those sorts of things, and then they create a geometric mean to then equalize it across the countries, and we're able to rank 150 countries globally in terms of the best place to retire. So you see some of these things in the Economist magazine tend to put them up, but we've created this for a client out of the US, which looks at things like the health index, and there's a whole bunch of feeders which go into that, finances in retirement, quality of life, and so on. This goes down to 150, and down the bottom you've got some African countries and Afghanistan and those sorts of countries. You can see Australia here. There. So this is really from an individual's point of view, where would they be best off? Where, finances in retirement, it's where inflation's pretty benign, yields are relatively okay compared to other groups and those sorts of things. So that's just to give you a bit of an international feel.
In Cyprus is 24th.
We did this this was 2012.
Right, good.
So, where's it good?
Material well-being.
Material well-being if your money's still in the bank, I guess. But, this was pre-priced. We can send you, if you're interested, we can send you the full report. It's like a 100-page report looking at those things. We've just done a recent, as I said, mishmash of a whole bunch of things. We've just done an institutional global study, 19 countries, talking to pension fund trustees to just get a sense. Those guys are really at the forefront of the money and the future retirement of people in these countries. And you can see here the average pet person having enough to retire. So coming back to that first slide, which was the pie chart with 44 and 8%, so 50% of the global assets being managed by these two countries. However, barely 1 in 8 of the pension fund trustees who are sitting behind the money that gets allocated to these asset managers don't believe that the average person is going to have enough to retire, which, I mean, that was quite interesting for me. We can see some other countries there.
What's the number for Australia?
They were involved there. So we had 19 countries, but the client that we work with didn't.
But we have that number in a separate report, right, if you're interested. It's 1 in 5.
Is it?
Yeah.
It's 20%.
Okay, so this is just some stuff around risk. I guess you can have this in the report, but what we're seeing here is that even though the long-term investors, institutions are still quite concerned globally, or that's broken down by region, things about volatility. For the DB funds, which is an issue in some countries, the liabilities have blown out and continue to blow out, and the industry have done a few things to create LDI type products and things to try to remove that risk, but from an individual trustee's point of view, they're still quite concerned about that sort of stuff. Pay more attention to risk, ignore that. This is quite interesting, home team bias. So we asked these 19 countries, the people that we spoke to. Okay, so it's quite bleak, of 3 in 20 in the UK and 3 in 20 in the US think that the average person isn't going to have enough to retire and blah, blah, blah. What we're seeing here is that they actually think their own fund, so I'm going to meet my liabilities, we're all okay, but other funds, not so good. And then the governments, most of them think they're going to do better on average than the government, which is just, I guess, a psychological interesting thing. And then we can break it down by the other regions where you can see how people do that. Risk, so what are they doing? I mean, they're still very concerned about risk, so currency hedging is the sort of number one, apart from the US where I guess most of the assets sit locally, so they don't really need to hedge much there. Again, I'll just jump through these. What institutional investors are, though, they're much more advanced in terms of alternatives. And the reason I put this up here is because from a retail investor point of view, we've been doing a lot of work with clients overseas. They're trying to look at, well, what's the next solution then? If traditional portfolio construction, 60-40, isn't working, then how can we make retail investments more appropriate, alternative investments more appropriate for retail investors? So we're starting to see, things that wouldn't even be considered on the radar of retail investment in the past. And a lot of this has been driven out of the US, and they've got concepts like durable portfolio and all this sort of stuff where you can put a whole bunch of things in there which might not necessarily be all liquid, but it gives you more of an exposure beyond just basically watching the volatility of share markets bounce up and down sort of thing. ESG, I'll just skip this one. UK, so look, I guess today's presentation is mostly focused on the UK only because the RDR seems quite closely aligned with FOFA and what's happening here. But that's the structure of the industry. You can see that the vast majority of advisors are still single advisors, whether they work within a network or work by themselves. That's two out of 3 of the remaining 20,000 advisors in the UK.
So if you think about that chart, people are going to be less ready than this year than they are and then last year. What are they saying?
Sorry?
So if you're saying single advisors, not part of a network, 5,185.
Oh no, sorry, what this is, the FSA, which has now been split into the Financial Conduct Authority, which is managing the advisors, and then you've got the PRA, Prudential Regulatory Authority, which is looking after the banks. They come out now and again with figures to say, well, this is how many advisors there are. So they basically say, at the end of, so basically just as we went into RDR, that was how many advisors they said were in the industry. However, 3 months after it, the numbers had dropped by about 30%. So I think a little bit of it was their accounting wasn't fantastic. But what we're trying to do, because we can only go off their numbers, because that's the only guide in the industry, is that this is how many advisors are left in the industry as of 2013. I mean, they might go down. It's indicative. We're not sort of hanging our hat and saying there are actually 4,400 single advisors and we'll go to court with anybody who says otherwise type thing. This is just trying to give you an indicative flavour. So that was 2012 figures, and that's the FSA's figures now. But it's kind of a pair. We look at the industry as a bit of a pair, where you've got 20% of advisors at the top of the pair who aren't really affected by RDR because they were already compliant. They've been running their business in that way for some time. The big challenge is the middle of the. I mean, there are still challenges for the advisors, regardless as if they were compliant before or not, because there's simply more compliance. There's knocks on the doors from regulators. There's paperwork that needs to be done. So the general gist is that it's an issue for the fatter the word, the more people who said that. So some people will close down, fewer clients, leaving the industry, higher costs. I'll skip this one. This is just last year versus this year. They're eternal optimists, though, advisors. They still come out and think that their business is going to be better next year than it was last year. This is an interesting one. If we look about, and the only reason I'm focused on this is because of the distribution. If we take those 20,000 advisors out of the UK market, then who is left there to sell these ridiculous number of funds out there? So there's a couple of direct providers. There's one group below called Hargreaves Lansdown, which has really become the dominant provider of the direct space over there. But that's okay if you're a semi-retired executive who is quite interested in doing that sort of stuff. But if you look at the average person, they don't use Hargreaves Lansdown. They're just sitting in this vacuum. They're buying crappy products off website comparison sites and those sorts of things. So anyway, what we're going to see here is another 3 years. Only 50% of those limit the reduced number of advisors now believe they're even still going to be around. You can kind of say this is if you ask any industry, anyone in the room now, where you're going to be in 3 to 5 years, you would get a natural figure which is quite low because people just don't know what they're going to be doing. So don't read too much into that, but that's just showing that you might be seeing more advisors leave. I'll skip through this stuff. You can see this in the report. This is based on the average size of the pot that an advisor does, because we do a quarterly Financial Times. We do a product called Celsius, which tracks advisor what they're expecting to invest in, and we measure their portfolios and all that sort of stuff. So that's just based on size, where the funds are likely to go. So what we're seeing here is more of a simplistic move. So post RDR, it doesn't look that much on here, but when you model it out, it becomes quite big. So a reduction in, these are actually single manager active funds, so there's a reduced allocation to them. Multi-manager, which is seen as being a little bit more expensive, so a slight drop off them as well. And this is where the growth is, model portfolios. So this is where Mrs. Miggins can come in and you can put her into one of 5 type products. And they're increasingly going to be decided, the structure of those model portfolios will be decided by the discretionary fund managers that were referenced at the beginning. So the advisors will stop doing this, and the power planners will pick where Mrs. Miggin goes and which DFM they use. I mean, I'm talking 5-6 years down, but this is a path that the industry has now gone down.
What are some of those discretionary funds managers? Like, what's their names?
Well, some of them are actually existing full fund managers. So a group like Jupiter, which is a big manager over there, they have discretionary service as well. But some of them are just groups like Bruin Dolphin and a few of these groups that don't have full, they don't do institutional investing or those sorts of things. They just have a bunch of, I guess, fund pickers, stock pickers, those sorts of guys. So they sit in between, like a buffer.
And how do they differ to multi-managers?
Well, multi-manager is, I guess, more of the product side of things. So I mean, some of them probably offer multi-manager solutions, but what we're seeing the growth in is really in the model portfolio space. So you mean like Russells and those sorts of groups? Yeah. So that's just modelling out the flows over time. I'll skip through that. That's just showing the influence of power planners. As you can see there, that basically half of, these are the number of advisors, so traditionally not really using them. That's going to reduce, more people will start using these power planners, and there's actually a little bit of it's a cottage industry. Some of them at the moment, might only have 3 or 4 employees, these power planning firms, but they're starting to get more business in the door, and their model means that they don't necessarily need loads of people. So there's maybe about half a dozen of them that are well known in the industry from a brand point of view, but you look at their business and it's 5 people working out of an office in Kidderminster or something. So it's quite interesting. So from a macro point of view, we might start to see some of the providers. So L&G, Legal General, big group over there, just recently bought Co-Funds, which it already owned 25% of that business, and it's now bought the other 75%. Groups are going to start maybe buying up anyone who has any influence. So DFMs, we might start to see them be acquired by other groups to try to have some bearing on where those funds go. The power planning firms will probably see the same. I mean, just to put it into context, so that deal that L&G did a couple of weeks ago to buy co-funds, which is, I'm not sure if it's the biggest or the second biggest, it's got like £40 billion under administration as a platform, and they paid £117 million for the 75% they didn't own, which brings the actual yield on that business is around, it's like 1/3% or something, which is just madness. If you think this is an industry which used to have really quite fat margins in it. So what we're suggesting in the UK is a reduction of influence from the advisors. I'll skip that one. And again, outsourcing. So at the moment, this is coming from a big base. You've still got 60% of advisors at the latter quarter of 2012 saying that they do all their in-house advice, asset allocation, blah blah blah. But by the end of this year, that's going to drop by 9% down to 51%, and you're going to see a jump. Partial outsourcing, so about 1 in 4 currently do that, and that's going to go to 32%. So we're just thinking over time we're going to start to see a little bit of a change in who is influencing the decision making in the UK, and that's pretty much it. I mean, there was other stuff I could have put in, but it was really about having a bit of a two-way chat with where Australia's at, and are you guys operating in a bubble? Is the market growing beyond the SG? Or is there natural growth in this market? Are you fearful of something happening like what's been happening overseas, really? So that's pretty much it.